Hello, happy Monday. Welcome back to another Monday market update. I'm Caitlin McKegg. I am a real estate broker here in Phoenix, Arizona. Every Monday, I am here giving you an update on what's going on in the Phoenix real estate market, and I also post other videos throughout the week. So thanks for joining me. If you're here every Monday, I appreciate you. And if you're new, welcome. Make sure you subscribe so you don't miss these updates in the future. Most of the time lately, I've been talking about some broader topics as we get started, whether it's economic topics or just what's going on in real estate across the country, and then we drill down to Phoenix specifically. But this week, so much happened in the Phoenix real estate market that I think is important for us to touch on. So majority of that information is going to be about Phoenix and from the Cromford report. So I'm going to start by talking a little bit about rates, and then we'll just jump into more specific stuff about Phoenix. Just a side note, I am a Cromford Report subscriber. They provide awesome information for their realtor subscribers to use and share with their clients, and I come here to share it with you guys every week. So thank you to the Cromford Report for their awesome data and insights. So let's start talking about mortgage rates, which is an ever-changing hot topic right now. So this headline here says 30-year mortgage rates dip below 6%, but pros warn there's a risk of a quick reversal to higher mortgage rates. So this past week, or leading up to this past week, rates were about 6% or over for the last couple weeks. And this past week, for the second day in a row, they dropped below 6% to a mere 5.88%. So that was encouraging, according to bank rate. That's where that data is from. And what happened this past week is we didn't have a whole lot of inflation data that was changing things. The testimony from Jerome Powell was talking about how they are committed to bringing down inflation and continuing to raise the federal funds rate. And so that actually was good news for the markets, which then lowered mortgage rates. So that's what we saw a little bit last week. Keep in mind, rates change every day. So until we see something significant, this is, just a little bit of a fluctuation, but that's what happened last week. And it sounds like moving into July, we will probably see the Fed continue to take aggressive action towards inflation and probably raise the funds rate again, maybe 75 basis points. So we'll see what happens in July. This last note here, this is from McBride, who is from Bankrate. He says, as for when we're likely to see rates rise above 6%, it depends on inflation. If the inflation numbers get better from here, we'll likely see a peak in mortgage rates. If the inflation numbers continue to get worse, then mortgage rates will move above 6%. So that is his estimate of what's to come. So keeping an eye on inflation and what's happening as it relates to inflation and in the overall markets is going to be important to know what's happening with mortgage rates. So let's move on, talking about Phoenix now. Let's get into rentals, because I haven't talked about rentals in a while. We're seeing a lot of things come up with rentals that I think is important because, as I've mentioned in the past, the rental market is typically the first indicator of what's going to happen in the resale home sales market. So it's important to pay attention to this, and there's some interesting stuff going on. So as far as the number of rentals on the market, we're seeing a significant increase. We actually have about 15% more this month rental listings than we had last month at this time. So definitely an increase there. Year over year, if we compare the rental listings, we've got 97% more rental listings today than we had last year at this time. So that's a significant increase. Our total active rentals right now is about 2,722 on the market, and that is the highest number we've seen since May of 2020. So clearly we are seeing a lot of increase in rental supply, and that will then, of course, affect rental rates, right? So here's what's happening with rent prices. Right now, when we look at average dollar per square foot for rental listings in Phoenix, the average is about $1.66 a square foot. Last month at this time, that average was about $1.70 per square foot. And get this, last year at this time, we were sitting at about $1.94 average per square foot. So we have totally decreased year over year. Then we look month over month, that's changed. And it's all because this supply is increasing and we just don't have many tenants getting into these rentals. So a little bit concerning, right? Because vacancies are really the issue when it comes to talking about, you know, market crashes and that kind of thing. We don't want vacancy. And so seeing that there is, we're seeing so many rentals come to the market, clearly they're not being rented. That's why these landlords are having to drop their prices. You know, something to keep a close eye on. And it's always interesting to watch the rental landscape. It was super competitive in the last 2 years, just as the housing market was. And now we're seeing a softening there, which is no different than what we're seeing in the resale market. So let's start talking about that. The contract ratio. This is another measure that the Cromford report uses to understand the health of the market and that kind of thing. It's a little bit simpler to understand than the CMI is, but let me explain it really quick. So the contract ratio is, they look at the number of active listings for sale as compared to the number of listings that are under contract. So in the last 2 years, we've had more homes under contract than available for sale. And that contract ratio has been extremely high. And down here, I have this little key. A normal market is about 30 to 60 for a contract ratio. Below 20 is a cold market, above 60 is a hot market, and over 100 is a frenzy. And you can look here to 2022, which is the green line, yellowish line. It is down here right now, but at the peak earlier this year, we were over 250. So again, if we go back here and see that over 100 is a frenzy, over 250, I mean, that was insanity. And you can see where we've gone from there. So the contract ratio is, you know, similar to the CMI, where you can see the trajectory of things, but it's just a little bit easier to understand what they're measuring. So today, the contract ratio for Phoenix is sitting at 62. And if we remember over here, we are just above normal if we're at 62. And it's definitely trending downward. So I would assume that we're probably going to see a lower number next week. This is the weakest contract ratio that we've seen at this point in the year since 2014. So this information or this measure is not seasonally adjusted like the CMI is. So it will fluctuate different times of the year, but being at 50 or 62, it's and you can just see it on the graph there. It's it's below all the other years in the past. So you can. That is the lowest that we've seen at this point in the year since 2014. And so it seems like 56, this is where the lowest point was in 2014. So it's reasonable to expect if we continue on this trend, next week we'll probably be at 56 or below. So we'll have to keep an eye on that. The Cromford report does talk about, it does give daily insights, and sometimes what they say is just so good. I'm not going to try to paraphrase it. I just want to quote what they say. So I do have something to share as it relates to this contract ratio. So what they said was, there may be many people who have yet to fully comprehend or accept how hard the brakes have been slammed on our market. My tip, do not underestimate the impact of these changes. Brace yourself for a bumpy ride in the months ahead. So wonderful, encouraging news, right? But again, I'm not going to try to paraphrase that. What they're saying is that is in relation to this contract ratio data that they shared. So let's talk about the CMI, which I know many of you are following and very interested in. And just to give you a quick rundown, if you're new here, this is an index that the Cromford report has created, and it really measures supply and demand in our market and tells us where we can anticipate prices going, whether it's price appreciation or just or depreciation or just deceleration with prices. So the way it's measured, anywhere between 90 to 110 is a normal range. Above 110 is a seller's market. Below 90 is a buyer's market. So where we sit this week, Big news, you guys. We are finally under 200. I don't know if I want to say the word finally, but that's what happened. We are under 200 for the first time in, I don't know what the data is, but it's been a very long time since we've been below there. And we continue to fall. So again, over 110 is still a seller's market, but when you compare 197 to 450, where we were about 2 months ago, it's a very big change. So our demand is still in the normal range. Technically, it's at 90.2. So I'm very anxious to see if next week that falls out of normal. I said last week it probably would be out of normal this week, but we're not there yet. And our supply is at 45.8, which means we're about 55% below normal for supply. Now, remember, this is seasonally adjusted, so there is no assumption as far as like summer's a slower season, that kind of thing with these numbers. This is already adjusted for those factors. So our supply is increasing quite a bit, and I'm going to talk more about those numbers in a second, but we're still 55% below normal, so it's not like we have an oversupply, and hopefully we don't get to that point, because we'll be having a very different conversation. So down here I have our list of all of the different cities, major cities, and what their CMI rating is. The cities that have seen the biggest change in the last month is Glendale, Avondale, Phoenix, Gilbert, and Chandler. All of them have seen at least 40% decrease month over month in their CMI. So that's a really big jump. And I have Buckeye circled down here because Buckeye is just doing its own thing right now. Buckeye is at 121.1. The Cromford report is saying that they will be in a balanced market next week if this trend continues. So that's some pretty big news. And what's really happening in Buckeye is the supply is increasing massively. In the last 7 days, there's an increase of 9% in the amount of supply on the market in Buckeye. And if we look year over year, Buckeye's supply has increased by, get this, 347% year over year. So the demand is softening there as well, but more than anything, the supply in Buckeye is just increasing at such a high rate that it's softening the market significantly. And if interest rates continue to go up and more buyers fall out of the market, that is really going to be bad news for Buckeye for how low they already are, because they could be in a buyer's market very soon. So if you're a seller who's been thinking about selling in Buckeye, please keep that in mind, because your situation seems to be quite a bit different than the situation in other areas of Phoenix. So that's where we stand with the Cromford Market Index. I did want to talk a little bit about another thing that the Cromford report mentioned. They said, so here's another quote directly from them: "The chance of a balanced market within a couple months is now very high, and the chance of entering a buyer's market in a short time later is increasing every day. The speed of change is unprecedented and dangerous to both participants and forecasters, with another 75 basis point increase in the federal funds rate suggested for July. The bad news for the housing market just keeps coming." Again, it's pretty straightforward, not the most encouraging news, but what I am interested in seeing is, are we going to plateau with all of this supply? Because you have to keep in mind, there are so many people out there that have extremely low interest rates that bought in the last 2 years. And I don't see any reason for them to list their home for sale unless they have to move, because why would you do that and get into a higher interest rate unless you really have to? So in my thinking, my logic, I feel like there has to be a stopping point as far as the number of new listings coming to the market. Maybe this is shaking loose all the tight inventory we've had for the last 2 years, and we're just seeing it all come out at once, but it will plateau once it hits that point where other people are like, no, I'm good with my interest rate, I'm good with my payment, I have nowhere to go, this doesn't make sense for me. So hopefully we get to that stopping point sooner than later. It's great to have choices for buyers, but the faster this supply comes on, the more concerning it gets for the market. So moving on, we're going to talk about the listing success rate. And this is looking at the number of listings on the market that actually close rather than cancel or expire. And, you know, just in the fashion of what we're seeing these days, it's a nice little downward trajectory there, not too surprising. And we're seeing, like I said, a lot of new listings come to market, and that is creating a lot of competition for sellers, and they're either not getting their price and deciding to cancel, or, you know, there could be a variety of factors, but we're certainly seeing that, along with a big fallout rate in homes that go under contract and come back on market. And I think a lot of that has to do with buyers who maybe didn't revisit what their payment was going to be since rates have increased, and they get under contract and realize they can't afford it, or they don't want to pay it and they cancel, or cold feet, or a number of different reasons. But we are seeing an increase in cancellations of under contract listings as well. So our new listings in the last 28 days, it has been 11,845 in the last 28 days. Okay, so keep in mind, like, over the last 2 years, the amount of listings on the market in general hasn't even gone above like 6,000 or so. And now in the last 28 days, we've seen 11,000 new listings. That's just insane. It's the highest number in a 28-day period since 2011. And it could be the highest number since before that, but the Cromford report was not tracking it until 2011. So for as far back as they've tracked it, that's the highest number of new listings in a 28-day period. The long-term average for number of new listings coming on the market is about 8,845. And this 11,000 number is a 34% increase over the long-term average. So that really illustrates, as I say, like, more new listings coming to the market. Those are the numbers. And the reason this is really impacting us is, again, because sellers now have a lot of competition and buyers have choices, and they also have a choice to not move forward anymore because it got too expensive with their interest rate. So our buyer demand is down and sellers are competing against each other now instead of having buyers compete for that one listing. So it's really changed the landscape. It's really softened the market. So as a buyer, it's great news for you if you can afford to purchase, if you have long-term plans to be in that property. It's still a really great time to buy for you if that's your situation, because you have more choices and you're likely to be able to negotiate a lot more with a seller right now. And if you're a seller, this is something to watch. If you need to list your house or you want to sell it before things change because we don't really know where we're headed, then I certainly encourage you to do that sooner than later, because things are changing on a daily basis. And if you are thinking about selling, but now you're a little bit concerned and you just want to hold on to things, I think in the next couple months, we'll start to see how things shake out a little bit better, for good or bad. So according to the Cromford report, we're probably going to be in a balanced market sooner than later. This is the one last thing that I want to quote from them. They say, if we were just suffering from deflating demand, the market would be cooling off gently. But if 34% more listings are arriving every 4 weeks, supply is increasing just at the wrong time and it cannot be absorbed. This is why we're seeing the fastest cooling trend the Greater Phoenix housing market has ever experienced. What we do not know is whether the extra listings will keep coming or if this excess new supply will dry up sooner than later. So that is all I have for you guys this week. Like I said, it was going to be a lot of stuff, a lot of things I wanted to touch on, a lot of changes, and bottom line is things are changing very quickly. So depending on your real estate situation, think through that information. If you want to chat with me about it, I have a link in my description below where we can talk further about your situation. So you can set up a time to chat with me or just reach out by call, text, or email. If you're thinking about selling, remember, I can help you with that. I also have a link where you can get your instant home valuation. Check the description for that. And if you're thinking about buying, I can also help you with that as well. I have a link to my MLS where you can search for homes there. So thank you all for joining me so much and walking through this with me. I hope it was helpful. Appreciate all your support, and I'll be back next Monday with another update. And stay tuned midweek. I may come on here and talk a little bit more about the contract ratio, dive into that deeper for different segments of the market. So thanks, you guys. Have a great week.